Thank you all again. My name is Ron Lake. I'm from Lake Partners, and I'll be the moderator of this session of the Greenwich Roundtable. Please excuse this sexy come-hither huskiness to my voice. I have a cold. It's not my Barry White imitation. Marty also has a cold, so bear with all of us. Anyway, this series is sponsored by Jeffries. And thank you to Steve McMenamin for organizing our event. Today's topic is Asset Allocation for 2000, Navigating the Risks, Charting the Opportunities. And actually, this is our fourth annual event of this type for investors, in which we try to take a step back to survey the scene and ponder some of the investment choices we face in the coming year. We're very fortunate to have three very insightful panelists who successfully wrestle with these choices every day, not just once a year. Marty Zweig of Zweig de Mena started his firm in 1984 and is now managing about $3 billion or so, Marty? $4 billion? $4 billion? I hate to depreciate your assets like that. He's also very well known for his very thought-provoking appearances on TV. Eric Fry launched Grants International, which is the sister publication of Jim Grant's Interest Rate Observer, in May of this year. And previously, he was a portfolio manager with Reynard Asset Management and has been managing international money since the early 80s. Spencer Lampert, next to me here, joined Tudor Investment Corp. in 1987. He's the managing director of market strategy and is involved in the management of the $3 billion some odd dollars that firm has. Now, not only was Spencer on our panel, this topic last year, this is actually his third appearance as a panelist at the Greenwich Roundtable, which in fact is a world record. Marty and Eric have not been here before, but they shouldn't worry. They have the advantage of starting with a clean slate. None of us know what they're going to say. Spencer doesn't have that advantage of being a fresh face of this group, but you're still safe, Spencer. No one remembers what you said last year.
That's what I count on.
Yeah, it's important. As for myself, a few of you might not remember or care what I said, but I do have something to say now. I have the prerogative of having the podium. I couldn't resist the opportunity to share with you this cartoon I saw in the paper a while. You can all see this, can't you? This is a cartoon from Oliphant, and it shows Greenspan sitting with a microphone and all this electronic gear hidden inside this big hollow bust of his head. And out from the head is coming this voice saying, "How about 1/4%?" And there are all these balding. I'm not sure why Oliphant always draws balding investors, but they're all, going like this in front of the bus, saying, "That's it, that's all? All right. Let the exuberance continue. Praise be unto thee, O merciful Greenspan." I thought it was amusing when it was printed on September 2nd, which was just after when the Dow pierced 11,300, right around the end of August. That was 1,000 points ago. So I thought the cartoon was amusing then. It now seems kind of quaint, if not downright just outdated. So much for cartoon characters shouting, "Let the exuberance begin," or continue. Marty, let me start with you. Where did this exuberance go? When are we going to see it again? Are recent concerns about the dollar and interest rates indicative of a new direction for the market, or are we just suffering from the fact that it's September? Let me turn over to you first to get us started on our topic of where things are going for the coming years as you see it.
All right, so you just want me to talk, do my thing.
Do your thing, whatever. You're going to ignore what I asked you, or address it. It's entirely your choice.
September, as everybody knows, is the worst month in the market. The last 4 years, September's been up at least 4% though each time. Does that sound right? Or did I get that wrong?
You don't have your mic.
Is it okay now?
Oh,
yeah, sorry about that. All right, forget what I just said. Anyway, I appreciate being here. I've never been here before, and I do know a hedge fund manager who did speak here last year, and he decided to spend the day up in Greenwich. He had a friend that belonged to a country club, and he figured he'd play golf. It's about this time of year. It was nice weather. He went over to the golf club and went into the locker room. He took off all his clothes and slammed the locker. and turned around and suddenly realized he was in the wrong place. He was in the women's locker room. husband is a hedge fund manager, so he didn't know what to do. All he had was a towel. So he had to make a decision. He had two choices. One, he could put the towel around his waist and walk out, but he was afraid people would recognize him and be foolish. The second choice, he could take the towel and kind of put it over his head like this, tiptoe out. And that's what he decided to do. As he's going out, there's three women sitting there, and one looks at him. She goes, "Well, at least he's not my husband." The second one said, "You're right, he's not your husband." The third one said, "Well, he's not even a member of this club." What I've learned in this business is you have to make decisions, and sometimes you make the wrong one. What I try to do is measure risk. If you don't know about our firm, we've been managing hedge fund money for 15 and a half years, and I've been in the stock market now 38 years. My partner Joe's been with me for 22 years. And our style is primarily long-short U.S. We dabble once in a while in foreign stocks or bonds, but it's tiny. We've never deviated from our style, and our objective is to make reasonable returns without taking on too much risk. Risk is the main thing. Joe runs the portfolio. I don't pick the stocks, I never have. He does. And my job is to know how much risk there is in the market and how much exposure we want. So I hope this will answer some of the questions you threw at me. I do have a handout, but I'm not going to go through every page. I'm trying to keep it informal. But the front page of the handout, if you do have it, is the main reason that we've had a bullish bias for the last couple of years, and that's inflation. And it sounds like an old story, but there hasn't been much inflation. And if you look at the consumer price index in the upper left box, we're running about 2%, which is in the 0 to +4 range, and the market's done 9.8% a year compounded when we've been in that range, and somewhat similar results on PPI. And people have been worried about deflation at times, although I think the last few months it's been more the opposite way. That if we were to go into mild deflation, you can see the returns kick up dramatically. It's only the extremes that the market hates, extreme deflation and extreme inflation. Of course, if inflation were to pick up even more, I get nervous about it. I'm not happy about the rise in commodity prices as far as the bullish case is concerned, but we've cut back for that. There is some commodity stuff in here later. You mentioned Greenspan and everybody praying to him. The lower box on the right kind of tells you what's going on there. The first line of that lower box on the right takes you back a year to when the Fed cut after the Russian crisis, and the Fed cut 3 times. As you can see, the average return for the market is up 24.5% a year after the triple initial cut, and we did better than that. So things actually went along rather normally when you consider it all. We've now had 2 hikes, though, which takes us down to the third to bottom line. As you can see, the average return after a second hike is minus 2.1. It's pretty flat after 6 months and not up that much after a year. So you're working against the Fed now in the market. But it's not necessarily a disaster. The problem is these are averages. And if you take 17 cases, you're going to get some where the market got killed. And you're going to take some where the market did pretty well. So, you know, it's a tough call. But certainly something's been removed from the bullish case because of the Fed. Although I don't really think it's the Fed, because Greenspan likes to say the Fed acts preemptively, and that's just not true. The Fed finally hiked on June 30th after rates had been up about 140 basis points. They cut last fall after rates were down dramatically. And 2 years ago, in March of '97, they hiked after rates were up dramatically. So that the Fed has a very difficult time preempting, because politically it would be very tough for them to act preemptively. I think the bond market really shows the way. And, you know, bonds have not been great, although the last few months they've been fairly stable after having moved up the rates quite a bit. The next page I'm not even going to bother with. It's just one of the indicators that we do. It's slightly positive. It shows that there's slight net shrinkage of stocks, which is still okay. The next page is more interesting. It's a proprietary indicator. I grade 24 institutional letters every week. And even though people like Abby Cohn would be in there, or Galvin, who are very bullish, on average, these people are quite bearish. I have 2-to-1 bears among these institutional letter writers. I graded on a 0 to 4 scale like college grade, so a 2 would be dead neutral. And as you can see, for the last year or two, they've been quite bearish, and they're having a tough time handling the market, other than like Abby and Galvin. And I think they're bearish for 2 main reasons. One are the valuations, and they might be right about that, but it's hard for most people to see the valuations in this market. And second, the technical types don't like it because the breadth in the market peaked in April of last year, and the average stock is not doing well. As of 2 weeks ago, out of 8,000 stocks, 74% were down from a year ago, April. The next page is the put-call ratio. I'm looking at a little bit older graph that you have. I invented the put-call ratio. I started my career, actually, I was a college professor and began writing articles in Barron's about 30 years ago. And I came up with the put-call ratio. I had done my PhD dissertation on options, and that's how I got my start. And I first wrote about it in Barron's. And of course, over the years, it's changed considerably. They only had over-the-counter options in those days. But this is the equity put-call ratio, deviation from trend. And you can see it's pretty good. It's been pretty good this week, too, although the market hasn't been. And as you can see, when that thing has been more than 7% above trend, the market's gone up 29% a year. So there is some pessimism out there. It really is. The next page is my sentiment model. And it's okay. It's moderately positive. In other words, it's showing more pessimism than optimism. The box in the upper left, it's not in perfect order, but in the 50 to 60 zone, the market goes up about 9% a year. So, the sentiment stuff's okay. It's the monetary that's not good, and that gets to the next page. And I think the main prop for the bear case has been the surge upward in rates. This is the 6-month change in 10-year bond yields. It's way up, although it's been flattish the last few months. You can see the market's done about 3% when the change has been positive, and when yields are down, the market's done 17%. It's one of about 8 zillion monetary indicators we have in our model, but the monetary model that we have is clearly negative now because there really isn't much good going on in the bonds or things that relate to it. I'm going to skip import prices. The CRB spot index is on the next page. And as you can see, it started to rise. And year-to-year change is getting close to the 0 mark now. And now we're in the middle category with average returns. If it gets up to about plus 10, then you start looking for negative stock returns. But commodity prices have been rising. There is a flip side to it. We still have not had much general inflation in the U.S., I think in part because commodity prices only reflect a smaller percentage of the economy than was true years ago. You go back early in the century, the economy was made up primarily of farming and heavy industrial stuff, very commodity dependent. Now we're much more of a service-oriented economy, and if copper prices go up or something like that, it just doesn't mean what it used to mean. And we still have about 2% inflation in CPI, and less than that in the GDP deflator. So that's why I'm not an outright bear, because I still don't see the inflation. Next page is this typical kind of monetary indicator we use. It's commercial loans at banks, consumer loans rather. By the way, people talk about all the debt. This certainly doesn't show it. It's actually a positive indicator. So what we try to do, I try to measure the risk in the market. I would say right now, we were about neutral a couple days ago. We've been buying into the decline, which means we're probably wrong. But, VIX went up over 30 yesterday. That's the volatility, implied options volatility. Put call's been good, and even the bonds have been better the last few days. Everybody's panicked yesterday because whatever average broke, it's 200-day moving average. When I first got in the market 38 years ago, I saw a 200-day moving average. Who came up with that number? Nobody questions this stuff. Why 200 days? I don't know. Although you could probably use almost any moving average. The market broke a trend. Big deal. We've run tests. Michael Shalso here is my main research assistant. How many times, once the market breaks it, how many times is it right, percentage-wise?
Less than 15%.
Yeah, I was going to say 80% of the time the market's wrong.
How much?
80-odd%. But if you're going to have a huge bear market, it's going to be right. And if it's a 10% correction, it's going to be wrong. So if you know that you're in a bear market, you should sell everything right now. And if we're in a bull market, you should buy. I think I'll stop on that.
Hard to dispute that.
Marty, thank you very much. Eric, what do you see from your vantage point and where things are going?
Okay, I'll dive right in here. First of all, I'll try to make my comments fairly brief, since I know a lot of you want to get to the office and take advantage of the latest buying opportunity we've got here. If you're like me, you're going to be pretty excited about the S&P in here. It's about 5 times FY 2032 earnings, something like that. Those are operating earnings, of course. I work with Jim Grant at Grant's Publishing. Jim's the tall one. I think most of you know who he is. I'm the less bearish one.
It's a very low hurdle.
Right. Well, I've got fair value in the Dow at about 4,000. I write Grants International, which is the international publication for Grants, and it focuses a lot on the comparative analysis between various countries, sectors, and specific stocks. A lot of times pair trades. We've looked at some fairly unusual ones, Mindspring and India's BSNL. We did that a few months back. Nike and Adidas, it's more ordinary. And the latest issue looks at 2 Japanese transport companies, Seino on the long side, Yamato as the sell. The topic put to me today was where to invest, and I have a pretty good idea looking around this room that I should be asking that question of you rather than answering it. I haven't forgotten some of the best investment advice I ever got was from my babysitter about 6 years ago. She came to me and said, what mutual fund should I buy? And I said, well, how about cash? How about a money market fund? And she said, no, I think you should buy the 2 growth stock funds I just bought. And I ignored her. Oh, that reminds me, I have to babysit for her tonight. Anyway, clairvoyance is not my strong suit, but we'll give it a whirl. Every investor operates under certain assumptions and observations, and probably the ones that I'm looking at are more important than the actual conclusions that I'm drawing at the moment. So the 2 themes that I think are important for international markets is that indexing has probably peaked, and therefore you might see a resurgence of stock picking. The second is that restructuring has become a global phenomenon, one of the most successful American exports. So under those overarching themes, I'll get into a couple of ideas. On the idea that the indexing is peaking, does the Greenwich Roundtable have an index, by the way? No. You're probably the only ones left that don't. I think everything has been indexed now. And to paraphrase Oscar Wilde, there's so many of them that they measure the price of everything but the value of nothing. We are indexed to death. And what it has created is what credit union analyst Dr. Jim Walker calls the tyranny of indexation, where you have so much money going into index kinds of names that the rest, the sub-index, the sub-titan kinds of securities are ignored. And so for people who can invest in those areas, who aren't constrained by some mandate or perhaps are managing smaller sums of money, there are a lot of opportunities there. A West Coast portfolio manager I know only buys stocks that do not have analyst coverage. And his sell discipline is that when 2 sell-side analysts pick up coverage, he sells the stock. Now, I think something akin to that might work as far as indexing is concerned. You buy the non-index name, sell it when it gets added to an index. So that brings me to where to stock pick then. Very succinctly, we think the most compelling investment region broadly is Europe. Most compelling currency is the euro, and the most compelling developing market is India. Obviously, those are generalizations, and I'm just talking about where we think the most prospective areas to look for opportunity are. Some of you probably remember a couple of years back, Byron Wien described Europe as a vast open-air museum. And at the time, it seemed apt, but the exhibit is changing, so to speak. Europe is not what it has been. There is a very, very evident budding entrepreneurial dynamism. It's most evident in places like Scandinavia, where you have very, very pervasive internet usage. In the spectacular growth of markets like the Neumarkt in Germany, and venture capital funds sprouting up, et cetera. And that coupled with more predictable monetary regime, and not to mention a cyclical recovery that is underway. Probably one of the most compelling features of the European landscape is, in my view, is a positive current account surplus. That's something that's not widely talked about, but I think it could come in handy as we move along here, especially given the situation in the United States. So Europe, at least vis-a-vis the United States, looks compelling. It's at least a relative buy, if not an outright buy. And by that I mean everything: the stocks, the currency, and even, as I alluded to, the venture capital market. Thematically, at least, I would be long the Neumarkt IPOs and short the Kleiner-Perkins IPOs. In other words, get long the European dynamism and short the sort of late-stage American VC schlock, if I can use the word, that's starting to appear. Some specific ideas we've written about include Buderus in Germany, selling about half its net asset value, deep cyclical, that has done well in a bad environment. Should a good environment materialize, you should expect something much higher, and they're also buying back shares. Espírito Santo in Portugal, and Portuguese stocks in general look pretty good. Moving over to India, we have some similar dynamics, actually. A recovery economically. They're supposed to do about 7% this year in GDP. A lot of secular change, both at the public level and at the private sector. And we've got Wharton MBAs sort of running amok in India, CFOs of a number of major firms that are implementing Western-style management practices, so targeting ROE, incentive-based pay, attention to the weighted average cost of capital, hiving off unproductive businesses, etc. And very low valuations. So there are, again, we've written about a number of Indian securities, a couple in particular, the telecom company BSNL, India Hotels. As a kind of macro play, it's pretty simple just to buy the funds on the New York Stock Exchange, which are trading at about a 30% discount to their net asset value. So India will certainly not be a straight-up buy. It has never been that way, and it will be probably the quintessential stop-start ride. But it looks like, I think, a very interesting 5 to 10 year buy. And that's the bulk of my comments. I do have one parting one, however. I have to take issue with this Solomon Smith Barney report on eBay. I'm going to quote it here. Our new price target of $275 per share is based on a 10-year discounted cash flow analysis, which assumes a 20% risk rate, gross margins of 85%, annual revenue growth of 55%, and a PE of 55 times our estimated 2009 earnings. Now, I've crunched numbers on this, and I'm coming in a nickel lower. So I can't recommend the stock. Thank you very much.
Spencer?
Tough act to follow. It hadn't dawned on me that I've been here 3 times, although as I look around the room I see a lot of very familiar faces. Fortunately, none of you have like the strawberries in your hand about to throw them at me, so maybe last year wasn't so bad, although I am going to get a transcript of this so I can keep track of it. Many of you here know of our firm and know that in the investment horizon, our time horizon is fairly short term. It's not day trading, which seems to be the glamour industry these days, but we do invest for, generally speaking, on the macro futures side in time frames of a week, 2 weeks, a month, 2 months, depending upon the liquidity of a market. So for me to be here in September to talk about the year 2000 opportunities is a little bit far ahead of my crystal ball, but we do look out that way and we do see trends anyway, although we trade more for the short term. And, well, given the recent action in the stock market, my sense is you might be a little more interested in what I think about this fourth quarter anyway than all of next year. And so I'd like to start there. Those of you that do know our firm know that we tend to put on our bear coats right around the fourth quarter anyway. So we have a natural predilection towards the bear camp in this part of the year. And this year, actually, the pieces of the puzzle fit nicely. When in past years you could argue, well, you were just fitting it to make it into your case, and that might be true. This year we do have a scenario in which the economic fundamentals, and I think sort of the psyche of what I'm hearing anecdotally as I go in my day-to-day business and meet people in taxi drives and whoever else, people in hospitals and wherever, just start chatting with people and you get a sense of the mood. First and foremost, economically, we do have good growth, and that's a double-edged sword. It's great while it's happening. I agree with Eric. It's particularly great in a place like Europe where you're coming from an output gap. There's a deficit there that this cyclic recovery will take care of, and that's usually a very good time to invest. In the United States, however, we've blown through that, and as Alan Greenspan has pointed out and Marty indicated, he's tightened twice. And I think therein lies the problem. You have a Fed on the move, and it's very curious to me when, for the balance of this decade, we have sung Alan Greenspan's praises as being clearly intelligent, prescient, savior of the markets. There's one newsletter writer who does this survey of key bankers and politicians around the world in terms of the investment community's confidence in these individuals. And Alan is just, the bar chart is up towards 100% every week or month. It's every month that this guy does this newsletter. So clearly, St. Alan is a theme that has lasted for the decade. And why people now think he's not going to get it right, or gee, he shouldn't be doing this, so we're going to second guess Alan Greenspan. Personally, I think it's a fool's game. I think the man has in his mind that growth in the United States is too fast. And yes, while we don't see inflation at the retail level, except at the gas pump, generally speaking, what he's looking at is inflation in the pipeline. He sees a very tight labor market. He sees growth, well, currently in 3%, but I'll tell you, I saw at the early part of this week, in about a 36-hour period, I think I read 3 or 4 pieces from different upstairs firms saying that growth might be north of 4%. Clearly, the trade balance is shaving some of that off, but I think growth with a 4 handle will scare the bejesus out of Alan Greenspan. And I think he wants to raise rates. I don't know if he'll go on October 5th. He might go on November, whatever the date of his meeting is. But I think he's prepared to raise rates. Eric alluded to one of the factors he likes about Europe is the current account surplus. Sadly, we have a large and increasing current account deficit. The present administration feels that, well, ultimately this will be self-correcting. Well, that's true, but in the meantime, we still need to attract a hell of a lot of capital to our shores, and Economics 801 would indicate that interest rates need to rise, or the interest rate differentials need to rise to keep attracting more capital to our shores. If the dollar stays weak, and then that's a big if, we do have a G7 meeting this weekend, they might do something, say something that will help get the dollar back on track. But if it stays weak, I think the stock market runs a real risk in this fourth quarter from a bad current account deficit, a weak dollar, a Fed that may or may not be on the move, but personally I think he's on the move. Psychologically, people are sitting there, as you all know, it's October. It kind of scares people. Generally, bottoms are made when people are scared, which is true, but I think there might be that scare factor affecting people's investment decisions, especially as we head into December and Y2K. I don't think Y2K is a big issue in the States technologically. Will it affect people's psyches? Will it affect their investment behaviors? I think it will. I think at the margin it'll keep a marginal dollar from entering the stock market. Again, I believe that's a blip. I think what you'll see is fund managers raising cash into year-end, which in and of itself is not bullish of the stock market. And then when the lights go on and everything works fine in the United States on January 3rd or whatever the first trading day of the year is, you're going to say, oh, geez, I got to now put this money to work, and you will see a blip. I think that's a very short-term timing thing around the turn of the year. So I think things could stay weak into the year end. You'll get a blip into the beginning of the year when, lo and behold, things are working well. And then you're faced with, well, what do I do for the rest of the year? Much like a purchasing manager who's going to sit here in the fourth quarter and make sure he's got an extra few boxes of whatever on the shelves because he can't get caught short, and they'll have a few less to build and supply in the first quarter of next year. It's a temporary phenomenon, but one that certainly has immediate implications. Throughout the rest of the next 15 months, I see the concept of global growth, coordinated global growth, in effect. We haven't seen global growth since 1994, and we all know what happened to the bond market in 1994. It wasn't a pretty sight. Interestingly, I think part of the problem with the bond market in 1994 was the extent of leverage in the system. I was in Europe during the summer of '94 meeting a bunch of banks, and one guy had to leave a meeting because he had to go to an insurance client and explain to them about a leveraged product that this bank had sold to the insurance company that they didn't quite understand. And I think that was endemic to the situation in 1994 where you had large, embedded, illiquid, leveraged positions in the bond market that all of a sudden started turning south. Well, I don't think we have the same sense of leverage in the bond market today. In the United States, I think you have that similar amount of leverage inherent in the stock market. If the global growth story is on track and stays on track for certainly the first 6 months of the year 2000, you could see interest rates rising, not just in the United States, but clearly Britain with 1.4% GDP growth has already started raising rates, which to me is a little curious, but they have their axe to grind. And I don't think that outlook generally speaks well of stocks. Last night I was out to dinner with a friend of mine who is in a similar situation as many of yourselves, and he said to me, he goes, Spencer, he goes, but if global growth works, why aren't Coke and Gillette going to do well? Now, won't they do well? And I said, yeah, course they'll do well. I said, I haven't looked at Coke and Gillette. I do know the chart of Coke looks horrible. But I said, economically, I don't know how they're doing. I said, but tell me, what are they priced at relative to next year's earnings? And he goes, 20, 26 or something like that. And I said, well, where is that the magical number? I remember not too long ago, price to next year's earnings was 13, 14. That was a good number. And so I think there's certainly room in there for valuation levels to come back more in line if this global growth scenario stays intact. One of the things Marty mentioned was commodities, and he's exactly right. Our economy is different than it was 100 years ago, and they don't feed as directly into final good inflation as they used to. It is an indicator that Alan Greenspan and central bankers still tend to look at. And as far as investments for you all, I think having a commodity exposure makes a lot of sense. This year, year-to-date this year, I remember seeing and they have a vested interest in promoting it, but Goldman Sachs and Jay Aaron had a little graphic showing that their commodity index was, beating all the other indices, and I think that continues selectively in certain commodities. I think OPEC will keep the price of oil high. Can it go higher? Yes. Can it go lower? Yes. But I think what they're doing is the right thing for them, and that'll, with global growth, keep the price of oil supported. I think base metals will be supported. They got so far below what we'll call fair value last year as a result of the debacle in Southeast Asia, and now as the economies of the world pick up, you're going to see this building back up of the prices. So I see base metals going up. I see energy staying strong, and certainly in the fourth quarter, you run a real risk of a quickly accelerating price in energy. See rates rising. I'd want to be defensive on my stocks. I agree totally with Eric that I believe Europe offers better value. If we do enter a bear market, then we personally, on the macro side, won't typically be long any stocks. And when we want to hedge, we would probably go towards Europe and buy some European futures. One thing to consider, though, I don't think one thing argues in favor of a short, acceptable bear market, and other things don't. What seems to argue in favor of a shorter one is currently, right now, having come about approximately 1,000 points, as Ron said, 10% off the highs. If you look at the stock bond allocation models, they're probably now tending towards allocating 30%, give or take, towards stocks and 70% towards bonds. As if and when stocks deteriorate, you will see that certainly increase, and I think that'll tend to limit it. Contrast that with 1987, where in early October 87, there was such a decline in the bond market that the stock bond asset allocation model went to zero. So I think we've already made this, the markets are making the adjustment move. I just think this adjustment has further to go. One of the other things that scares me is the notion that, and it's been exactly the right prescription for people to do, and that's to buy the dip. And if you are a long-term holder, I suppose that's right. As I said, that's not our game. But one thing that scares me down 10% from a high is a sense of almost apathy. I think people say, yeah, we've seen this, we've been there before, and they're not worried. I think bottoms are made when there's fear in the market, and I don't really see a lot of fear just from talking to people. So that also tells me there might be further to go.
Spencer, thank you. Marty, I think I noticed you shaking your head every now and then during Spencer's...
I was on the Fed move.
Coffee, I'm very
I'm not sure if you want to elaborate on any particular point or not.
I don't remember when I was shaking my head.
It was on the Fed, I think.
On the Fed, with the Fed's intentions, perhaps? Or...
Well, this is too subjective, so it's silly. I mean, you could argue about how many angels can dance on the head of a pin. I don't think Greenspan's that worried about growth. That's one thing I was shaking my head at. But, I mean, that's just an opinion, so you may very well be right.
Okay. Are there any other questions or comments? We'll open it up to the floor now. Please.
I have a question. With respect to inflation, the purchasing management numbers are showing a big pickup. Unemployment at a record low, and yet the CPI numbers seem to conflict with some of the purchasing management numbers. Is there any comment on, are we going to see a pickup in CPI? It seems like prices are going up, real estate prices, particularly in Greenwich, keep going up. And is it there, or is there something new in the world that's going to prevent it from showing up the way the government reports CPI?
You asking me?
Any comments?
Well, first of all, I think that one factor that's going on is a thing called the internet and technology, and it's the most dynamic thing that I can think of in history. I mean, the wheel took a while, and fire took a while, and so on. This is unbelievable, and it's a tremendous deflationary force because it's giving you transparency. If you just go back to Economics 101 and look at pure competition, this is it. And if you look at the characteristics of pure competition, it really means that prices go like this. And I think you're seeing a lot of that. I think it's keeping the lid on things. Plus the productivity, I think, is being vastly underestimated by the government. And at least in this case, I don't care for government, but it's pretty hard to measure it anyway. But I mean, I just look around your own shops and see what kind of productivity there is vis-a-vis 5 years ago, 10 years ago, 15 years ago, or go into any store and see what goes on. And I think this is the other side of the coin. So I think long run you're going to have to deal with that. I think it's going to keep a lid on inflation. Obviously other things could pick up inflation.
One thing I'll add to that, I agree with Marty on that. I think the internet, a global Europe, all are creating a much more fiercely competitive marketplace, and that de facto is deflationary. The interesting thing to me is, as I read through the various economic model builders that we get newsletters and everything, the ones I really respect all show CPI inflation picking up next year. But to that I'll say, anybody who's ever designed a system knows they break down over time, and we might be at that break point in time because of the internet and the global competition. But if you just use past data and build your models about CPI, they would show it picking up next year in the U.S. toward 3.5%, 3.7%.
Marty, as an executive recruiter, I can attest that in the last year, the internet has been our biggest growth area.
I can understand that.
Do you have a question there?
Yeah, Mr. Lampert. But from what you just said, is that making you change whatever your model in terms of PD ratio relative to interest rates? I mean, something probably has some kind of ratio to look at on that.
No, I still think if I wanted to look at it just on a pure fundamental value, I think we're still overpriced in the U.S. market. And if inflation's 3% or 3.5 or 2.7, it's not going to. There's other dynamics at work that would argue that make me feel the same way. That doesn't change how I feel about it.
Give it back, yeah.
I guess question for the panel. The comment earlier about technology and deflation. If there is no pricing power in the system and there's competition driving pricing, that means margins are compressing dramatically in corporate America as well as other areas. In terms of the PD ratio, if we get 25, 30, 32 on S&P down, and the narrowness of the breadth of the market, it seems that there's very few arguments you can make from a bullish point of view on the equity market in the United States. And I'd like just these comments in light of your earlier remarks about pricing pressure and multiples.
You're singing my song, so you guys better answer
Well,
that.
my comment is I agree.
At least me, huh? Because the competition is forcing companies to cut costs, that's why you're seeing all these takeovers in this global. And people are getting laid off, and companies are getting right down. You've got to get rid of all the excess levels, and there's still plenty of that left. And profit margins are high now, not low, despite all this lack of pricing power. We've had no pricing power for several years, and yet profit margins are high. I also think this stimulates business. I mean, just the internet alone stimulates business. You can sell to more people, you reach more people, they get it at a better price, and they have more money to spend that way. So I know it is kind of peculiar because if you go back to Economics 101, the profit margins do contract, and maybe long run that's what's going to happen. Well, when we're all dead, so. And we only care about the fourth quarter anyway, right?
Mike, are there particular areas that you're finding most opportunities?
Well, I'm not the stock picker, but, we're pretty heavy in internet, some technology, cable type stuff, and energy as well. Those would be our big ones lately. But Joe has a quick trigger, and come back in a month or two, and portfolio could look different.
Right. Any other questions?
Marty, I'm a closet technician. Are there any accurate leading indicators out there that we should be looking at?
Technically?
Yeah. Your put-call ratio is one, but
I kind of consider put-call as sentiment, and I don't know if sentiment is technical. If you consider sentiment as technical, I'd look at the whole raft of them. Just the technical stuff alone. I mean, if you held a gun to my head and said you could only use one thing, I could go with some sort of momentum system because I know it would keep you out of the big moves on the wrong side. You get whipsawed to death. And in the long run, you'd probably equal the market with less risk. But all the systems, and Michael builds them, that we have, and we take monetary indicators, sentiment indicators, and you squeeze everything out of it, and then you overlay it with some sort of momentum. The momentum never adds any return, although it does detract from risk. And I think that most technical systems are based on some sort of trend following or momentum. And those that get you into overbought, oversold are the ones that, they work for 5 years and then you get an 87 and you're dead. So
what about
pick your poison. There's no free lunch out there.
Thank you.
One last follow-on. This was entitled Asset Allocation for year 2000. I know many people talk about the alternative asset class. I'd be curious where you people think the fixed income markets are. We haven't talked much about it in terms of the domestic and international fixed income market. The implication of what Greenspan is doing in this international situation. Talk a lot about domestic U.S. and U.S. policy. How does that happen?
Well, I think Greenspan is largely, not 100%, but largely fixated on the U.S., especially as we go into an election year. I think you'll see a lot of heat being placed on the Fed politically. He's going to be fair game in this election season. But so I have a hard time, given what I talked about in the U.S., being long U.S. bonds. But I think over in Europe, especially for this, in Europe, in industrial Europe, for the fourth quarter, I think I could see, not in the UK, but in continental Europe, them lifting, bonds rallying a little bit, just because I think they've been oversold probably by the Japanese as we go into their year end here in September. So I think you could see a natural bid come in. What I would caution in the fourth quarter is I am convinced that there is a movement away from illiquid and high-risk assets, and it's going to exacerbate into December 31st. Our firm is not unique in studying it now and deciding which traders get capital for what markets. And I can tell you that we see the loss of liquidity now, and we're only at September 24th. I can't imagine what it'll be like as we get towards December. And so that will figure, and you will see, I think, credit spreads and in this world of indexation, if there was a index of either illiquid situations, you'd see the spread between liquid markets and illiquid markets blow out. So I think that's going to dominate the fourth quarter. And then the first quarter, God willing, everything works out okay, you'll see a resumption of the move toward higher return assets.
I've got a comment on that. I wouldn't want to be out on the long end of any bond market at the moment. I think you have to take the recoveries in Europe and Asia, India, China, starting now for real, and also the commodity rallies for real. So I would be very, very short and very high quality. So short-term sovereigns, and as I said earlier, I'd want to be in euros. Any other questions?
If not, I know some people wanted to get out of here early just to get back to their Bloombergs. So we'll wrap it up. Spencer, thank you. Eric, thanks very much. Marty, thank you. Thank you, St. Alan.